Welcome back to Fast Market. I'm Tom White, joined by Kevin Hinks, and also we bring Scott Bauer, CEO of Prosper Trading Academy, back with us. Hey guys, did something come out? Because we're now positive, except for the Russell 2000.
Except for the Russell, which is off its lows. Everything else is, slowly, but these aren't big numbers, but they're up, 0.2%, 0.23. The Dow's up 0.4, so they're up.
Yeah, and I think we're starting to see a little pullback in treasuries that might be helping out equities at this point. Got the 30-year down 10.
Wait, bonds down are good now?
I think so, Kev, but...
Wait, time out.
Right.
When did that happen?
Didn't we want that?
We wanted bonds up.
Go up so rates would come down?
Yeah.
Exactly. Yeah.
I can't.
Flavor of the day.
We've been pounding the table on that. The disconnect between rates and equity markets this year been pretty astounding. So.
Okay, here's the question that comes up in Costco. What Andy Swan just reported to us, and we talked about, Scott, we got off on a little tangent about they are so transparent.
I was listening.
Oh, okay. That they come out right on the number and the stock sold off. It was a great trade, trading it after the number came out.
Yeah.
It was.
Right?
Because it was a good report.
It was a great report, but
Revenue
it was right on the
beat.
money.
Yeah.
And the street, if they hit right on the numbers, it's got to be bearish.
And that's one of those psychological, emotional trades that's in the marketplace right now.
Yeah.
That the first reaction, everyone's first reaction to everything right now is to hit the sell button.
Right.
And this was one you really got an opportunity after that big drop off, to dissect the numbers. Much like we talked about in the last segment when we were talking about if you do an earnings trade, do you buy some extra time to let the analyst, really take a look at that? That was certainly one of the instances there.
And you guys make a good point on that particular price action that we saw post results last time, Kevin. Sometimes earnings plays aren't the way to go. Maybe you wait for that move after the earnings.
Because if
you're
Costco,
unsure.
If they are so transparent that it's easier for the analysts to get this right on the nose, and because they get it right on the nose, the stock sells off on that knee-jerk reaction. Maybe it is a trade after the fact.
And you bring up another point that we talked about during that last discussion about Adobe is what type of duration do you want to do that trade in based on earnings? Because if you look at Costco, a couple weeks after those numbers came out, we were almost back to those levels that we saw pre-earnings.
It was a great trade. I traded it the last time it came out like this. It was a great trade.
All right, so we're looking at Costco.
Yep.
Now, the move in this stock, it's about $226, only $8.15.
Tiny.
It's almost like that. But Kevin, take a look at the options stats page for our viewers.
We always do.
Current IV percentile, only 61% into earnings.
But, based on where we are in the world in terms of implied volatility, that's not really high.
No, I was going to say that's pretty cheap going into earnings.
Right.
Actually,
Yeah, and I think that's reflected in that anticipated move in these shares, which is only $8 right now. So volatility is a tad bit elevated, Yeah,
the stock's come about $8.50 off the high.
Yeah.
So I would expect vols to be a little off the high, but make no mistake. And here's another thing we can do. Let's see what
You can add a volatility
study and see if they've come down.
Yeah. So that
You get implied vols have come down in there.
Remember that spike in February and the overall market volatility kind of skews this a little bit, but we're still, at the upper end of it, the upper 50% or 60% of that 52-week range in implied volatility. But what are we looking at in here, Kevin, based on what we're seeing in the option market?
Yeah, the main question I think you want to ask yourself is, do I trade it before or after?
Right.
Yeah.
Right? Especially, here's this.
Especially with that move, only $8.
Yes, exactly.
Anticipating with 1 day to go until expiration. Do you look at it that way?
Probably not a fade,
And
right?
think about it this way. Scott, if you have that thought that, hey, man, this $8.15 anticipated move in Costco is not big enough. What if it does move $20 post-earnings? It's a $226 stock. It can happen. What if I bought a straddle in there? Like I bought the call, bought the put at the money, and you hope for a move. It's risk defined, but you're working against positive time decay and falling volatility.
How about this? Go right to the chart and look at the last earnings event. It closed the day before earnings 233 and change. Look at where it closed the next day. 218. So that's a $15 move. That's double the expected move right here.
Yeah. So taking that into account, what are we going to look at here, Kevin, as far as a possible trade?
I think you got to play for a move outside this range, frankly.
Okay. So what kind of strategy do we use for that? Do you use long verticals because volatility is not at extreme levels. It's high, but it's not at extreme levels.
Don't you think? I mean, this is a good one.
Yeah.
I almost wanted to. I want the event to happen and trade it after,
and then trade it.
I want the stock to make the first move.
Well, here I'm gonna show you something, Kevin. Go to the trade page. I want you to sell the 217.5.
Call or put.
Make it the 215 puts in that near the 14 December weekly series, and then also sell a call on the upside. And I want you to go up to the 235 strike, Kevin. Sell that one. Now I want you to buy the straddle in the December 21st weekly or monthly series. So I'm going to buy the straddle. So I'm buying a potential big move in there, but I'm also
227.
Yeah, 227.5. We'll do that one. So he's buying the straddle in there and selling a strangle in the near term. You're basically paying an $8 debit for that. Go ahead and analyze it for our viewers, Kevin, to do that, because you can buy the straddle outright without selling any options. I think we've got something else in there potentially.
No, I think we're okay. I think it's just here. I'll make the screen bigger.
Now look at the Analyze tab on this particular trade. Now there's a bunch of volatility plays in here, because if Costco doesn't move after earnings, this probably won't perform that well, but you're expecting a move in there, and we've got those ranges out to those strikes, which is 215 and 230.
227.
And 235 on the upside. Those are the optimal prices where you want it to go, but that's a way to play it.
Because it's $8 and $12. That's why this is off a little bit.
Yeah, so we're a little bit lighter on on the call side.
That's why it's not equidistant.
Not equidistant, but this is a way to play a potential move in it, but you hope that it goes to either one of those strikes, Scott. Your take on a strategy like this if you're playing instead of buying just a strat.
Yep. So we didn't talk about this, right? Let's be clear. We didn't talk about this. The suggestion I was going to make was very similar. Sell this week's call and put like you have, but instead of buying next week's straddle, I'd buy the same call and put next week.
So a double calendar.
Double calendar, strangle swap.
Yep.
You're buying a calendar put spread, buying a calendar call spread, with the expectation or the hope that you still get that move right to one of those short strikes this week. That premium collapses, and you're still holding next week's options that, they're not overly expensive. They will come down from a volatility standpoint. That's the way I would do it, because I just don't want to outlay the $7-8 buying the strap.
That's the trade-off. The cost to get in.
Because you are talking about a 20 Vega on that spread.
Right.
It's a little chunky.
It is a little chunky. And if I do it with the strangle, I have less. Bigger impact on yours. Less impact on mine.
And less cost.
Less cost on mine.
And less risk on that.
The reward to risk is different.
Great way to look at similar strategies.
Exactly.
And they're both, Kevin and Scott, both in the double diagonal strategy that's on the Thinkorswim platform.
Both long Vega, just a little bit of a lower debit on his.
Yep, so Kevin's going to go ahead and put that in a couple times, and then we'll look at that tomorrow post-earnings. I'd like to thank Scott Bauer, CEO of Prosper Trading Academy, for joining us today. Great stuff today. Great information, great content. And Kevin Hinks, as always, he's the rock here on Fast Market. All right, that does it for our show. Tune in tomorrow at 10 a.m. Central Time right here on the TD Ameritrade Network. Have a great day, everyone.